Three-day losing streak on the S&P 500, attempting to make sure that it's not day 4. Live from New York City this morning. Good morning, good morning. The countdown to the Open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Live from New York coming up. Apple in some pain ahead of next week's launch. GM's 16% pay raise offer quickly slapped down as Goldman is gearing up to cut underperformers. We begin with the big issue, rate hikes on ice.
The Fed's on ice.
Probably pause.
Press the pause button.
The pause in September.
Pause and wait a little bit.
Unless you got something very significant on CPI, I think they're not going in September.
The real debate amongst investors is whether the Fed goes again later this year.
Does the Fed go one more time?
The question will become the November meeting.
They're going to want to keep November in play.
If you look at the labor market, there is an argument to go stronger, and there is an argument to pause.
The job market is starting to weaken in a lot of ways.
These cracks are forming.
If you look at claims, you'd think the economy's on fire.
The Fed's job now is much more complicated.
There's a lot more data between now and the end of this year for them to think about.
Does inflation continue to soften into the end of the year, or do we get a rebound?
Where does inflation finally go?
We'll have to see how the data plays out.
The data is next week. Joining us to discuss, I'm pleased to say, always a pleasure, Mohammed Al-Erin of Queen's College, Cambridge. Mohammed, let's start there with the Fed in a few weeks' time. Are rate hikes on ice, and can CPI next week change it?
So CPI next week can definitely change it, not September, but can change the next rate hike at the end of October, beginning of November. John, there are bigger issues here. I think the discussion is going from whether they will hike or not to what's the overall impact of the level of interest rates. There's also now more discussion of how high, not how high, how long are they going to stay there? And underneath all that, John, are some really challenging technical issues about monetary policy. Everything from R-star to, what are the real lags in play. This is a very complicated time for the Fed, and markets should not jump to conclusion too easily as to what's going to happen beyond September.
Speaking to those complications, Mohammed, some contradictions in the economic data this week alone, and maybe you can help us. Jobless claims at the lows we haven't seen since February. The ISM was pretty punchy. The beige book screams slowdown. I've been asking all week, Mohammed, I'm sure you've heard me ask it, how much weight should I put on each data point that's coming out at the moment? What's given me a clearer story of what you think is happening?
So I think the consistent story, John, is that services are strong. And they are strong in employment, they are strong in wages, they're strong in output. And that is a very important thing to focus on. Beyond that, you have massive ambiguities. Beyond that, you have also the dependence on the rest of the world, which is in a very different place from the US. So I think the key issue is get services right. And if you get services right, you can explain much of what's going to happen going forward. But there are other issues that are going to become more important as we go deeper into 2024.
What do you think those issues are, Mohammed? What's number one for you?
So it's the supply side, John, and the way it plays out, whether it's labor negotiations, whether it's the price of oil staying so high when Chinese demand is under pressure, whether it's what's happening to Apple in terms of geopolitics and what that does to supply chains and what does that to demand chains. There's a lot of aspects, but supply is the number one. We've transitioned from a world of insufficient aggregate demand to a world of insufficient aggregate supply. And that's going to play out for not just 1 year, but for a number of years.
We talked about crude earlier this week being at highs we haven't seen all year, back to November, $90 on Brent. Mohammed, if we just looked at that one commodity, I'd be with you. I'd say that's just a supply story. The Saudis, Russia pulling back. But iron ore's in the mix as well at multi-month highs. We just talked about the contradictions in the US data. Let's talk about the contradictions in the global story. We're told slowdown in Europe, we can see it. Slowdown in China, we can see it. And then I see commodities where they are, Mohammed, and I'm trying to reconcile those two things. Are those two things competing with each other for you?
So once you go beyond the supply story, it becomes very specific. You can explain a lot on the supply side. You didn't mention food, but food prices have picked up again. So there was a lot to be explained by the supply side. But then if you go to individual commodities, you will have other factors playing in. John, I mean, for me, there were three big surprises in the first 8 months of the year. 2 positive, 1 negative. The negative we know is China. The positive we know is the US, but also Europe was better than many expected. Going forward, China doesn't recover. Europe doesn't maintain a positive surprise. It's all about the US when it comes to global growth.
Well, let's take that story, push it through FX. You know what we've got? Stronger dollar. 8 weeks of it, 8 consecutive weeks of dollar strength. Is that because the US is just so great right now, or the rest of the world, Mohammed, is so bad?
It's both. It's U.S. exceptionalism in absolute and relative terms. That results in rate differentials. That results in flows of foreign direct investment being even more concentrated in the U.S. It is all about relative and absolute U.S. exceptionalism.
Well, Europe's in a dark place going into the ECB next week, Mohammed. Can you speak to me about the inflation growth mix you'd expect to see from Europe over the coming quarters?
Yeah, it's tricky, John. I mean, if you're worried about stagflation, it's Europe and it's the UK where the threat is highest. And it's a really tough situation for the ECB. If the ECB wasn't a single mandate central bank, they probably wouldn't hike. I've put a 55% probability that they end up by hiking, but it's that close, John, as to whether they should hike again.
Split right down the middle. There are things that Fed officials can say right now that ECB officials cannot say. We're in a good place. Mike McKee caught up with John Williams in the New York Fed. Take a listen.
Right now, I think, things are moving in the right direction. We've got policy in a good place, but we're going to need to continue to be data dependent, watch the developments and assess what we need to do.
Mike McKee, are we in a good place?
We are in a good place. If the Fed could design where it wanted to be with its policies, this would probably be it. They don't know exactly what's going to happen, but right now they've got low unemployment and inflation that's going down. John Williams, in terms of the September meeting, put the nail in place. Lori Logan from the Dallas Fed hammered it home last night, giving a speech, and she's the most hawkish member, pretty much, of the Open Market Committee at this point, saying another skip could be appropriate, but caveats that with skipping does not imply stopping. So I think what you're looking at here is definitely pretty much everyone in favor of skipping in September, maybe Mester and Bowman. We got the sorting hat out now that we're heading into the final week before the Fed meeting and the quiet period. And you can see on the left-hand side and in the center, there's a majority who've said we can skip this time. Not everybody thinks they should skip in November, but you go on to the calendar and you see what's up next week besides CPI. There's a lot of data coming in that could weigh on them, but I think Mohammed said something very smart. The CPI is probably going to affect what people think of the November meeting rather than the September meeting, in part because economists are pretty good at forecasting CPI, but in part because so many Fed officials have already set the market up to get through the September meeting without a move. But watch retail sales. And of course, the big question next week is going to be whether the UAW goes on strike. That would have a significant impact on the economy, probably short-lived, but we'll have to see. And that is the big wild card for next week, along, John, with the hurricane that may or may not come.
I've seen some of that. That does not look good. Mike McKee, thank you, sir. Looking ahead to next week. Mohammed, Mike talked about it. You mentioned it in the last 5 minutes. These labour debates, unions, the Detroit Three and UAW. I've asked this question this week. I'll ask it of you, Mohammed. Do you think that's the dying embers of a hot labour market, or maybe the story that's going to stay with us for a while?
It will stay with us for a while. This is an indication that labor has more bargaining power. It has taken decades, but labor has restored some of its bargaining power. And you see this not just in the US, you see it elsewhere as well. And that's another supply side issue. John, can I just say something? Mike McKee's interview with John Williams was excellent. His mention of what Lori Logan said was really good, but the quote that really hit me from her last night was when she came to talk about what approach she needed on monetary policy. And she said something like, we need a very calibrated approach as opposed to, quote, throwing buckets of cold water on it. And I think that that is critical going forward, is what does calibration mean? We're no longer in the phase of catch-up where you made a mistake, you called it transitory, and you have to rush. Now it's really back to old-fashioned calibrated monetary policy, and that gets a lot more complicated.
Let's get away from the last month or so. Looking ahead to the next month, Mohammed, let's talk about the complications of maybe the next several years. There was a headline from our reporting on the G20 of a draft of their final communique, and it read as follows. The G20 sees a challenge to long-term growth from what they called cascading crises. And right in that moment, Mohammed, I read that headline and I thought of your book coming out, Brown, Spence, Al-Arian, A Plan to Fix a Fractured World, Perma-Crisis. Mohammed, can you breathe some life into that conversation? What is it that you and Gordon Brown and Michael Spence see that maybe speaks to what the G20 are talking about this weekend?
So that book originated from Zoom calls. The three of us had weekly Zoom calls. And after a while, when talking about going from crisis to crisis over a number of decades, we ask ourselves why. And basically it comes down to three issues, John. We haven't figured out a way to grow in a high, sustainable, and inclusive manner. So it's about growth models. Domestic economic policy management has been lacking. That's a second issue. And global coordination is at the lowest level that the three of us could remember for a very long time. So we asked the question the other way, is if you want to get out of this notion of cascading crises or perma-crises, what do you do? And we wrote down basically a plan to fix all three.
Looking forward to getting my hands on the book, Mohammed. Should we finish with an easy question? Jets-Bills, Monday Night Football. I had to zoom in and see the tie, the Jets tie this morning. Mohammed, what are you looking for from the team this season?
I'm hoping for a good season, but I tell you, our first 6 games, including Mike McKee's Broncos, are quite tough. So fingers and toes crossed, and as I'm wearing the tie, us Jets fans, us long-suffering Jets fans will do whatever it takes and whatever we can to support our team.
You were slightly critical about taking on Aaron Rodgers. Do you still feel the same way?
Look, John, it's done, so we're fully behind the team now.
Mohammed, thank you, sir. Good luck for the rest of the season. We'll catch up with you soon, no doubt. Mohammed Al-Arian on a bunch of issues looking ahead to next week. More still to come. We're about 20 minutes away from the opening bell. Your equity market is unchanged. It's dead flat. Let's get you some movers. Here's Abby.
Well, beneath that flat surface, John, we do have quite a few stocks moving a bit to the downside. Let's start out with the shares of RH. They are falling, down 8.8%. Now, interestingly enough, the quarter was decent. There was a massive adjusted earnings beat. The revenues beat was also strong, but it's the guide investors, analysts, and traders are worried about. The third quarter revenue midpoint misses. The company is cautious on economic challenges, and one analyst saying that the guide simply was not good enough. As for Kroger, down 1.6%. A mixed quarter. They beat earnings, missed sales. The second half view a little light. Now, Kroger and Albertsons, they're selling 413 stores to C&S for $1.9 billion. That was also a piece of the information that came out this morning. And they're also saying that their merger is on. As for Apple, well, John, we finally have a bit of a reprieve here. A small gain, up 0.5% after a 6.4% two-day tumble on the China banning the use of iPhones in certain settings. At the lows, down 8.5%. At that point, John, that selling was the most intense we've seen since September of 2020. It's going to be interesting to see whether or not this small gain in the pre-market can hold.
Abby, thank you. Coming up on this program, Huawei dropping a smartphone upgrade just as the G20 commences in India.
China faces a variety of both short and longer-term global challenges. I don't see it as having very significant direct impact on the United States.
The latest on US-China tensions up next.
China faces a variety of both short and longer-term global challenges, economic challenges that we've been monitoring carefully, including less of a pickup in consumer spending than had been anticipated. China has quite a bit of policy space to address these challenges. So we're monitoring the situation. I don't see it as having very significant direct impact on the United States.
Secretary Yellen at the G20 summit weighing in on China. President Biden expected to arrive in New Delhi this hour amid simmering tensions. Air Force One just touching down in India right this second. China planning to expand its iPhone ban to state companies and other government-backed agencies. The US kicking off an official probe into the chips used by Huawei just as the company debuts a new and more powerful phone. Your team coverage starts right now with AMH and Kelly Lyons in Washington, D.C. Anne-Marie, looking over to India, what are you expecting?
Well, this is really the U.S.'s chance, with both Xi Jinping and President Putin not there, to make sure that they are garnering the support of the developing countries, the global south, that has been put in a predicament with this war. Remember, India has walked a really fine line, at times not even being able to call it a war. So, Jonathan, when it comes to the communique, the bar seems very low. For some in the West, it was a low one they were able to clear at the G20 in Bali, when they were able to say that most members condemned this Putin's invasion of Ukraine. Initially, China wanted to get rid of it at this summit, but it looks like they are dropping that. But that will be one of the bars to clear. The other, of course, Jonathan, is a lot of this is going to be about what the West can do for the global south, what they can do in terms of development funding. The U.S. is really going to want to talk about funding for the World Bank. And for them, they're really trying to outline, you can still stay with us, we will support you, and this is an alternative path to Beijing's Belt and Road.
Xi Jinping will not be at this G20. Katie Lyons, I just wonder if these are coincidences or not. Gina Raimondo, the Commerce Secretary in China, Huawei unveils a new phone. G20 is just about to start. They unveil an even bigger new phone. What's your take on this, Kaylee?
I don't know if I can draw any firm conclusions, John, but the timing certainly is interesting, or at the very least, a very strong coincidence that this would be happening. Really speaks to just the tit-for-tat relationship and how it's one step forward, seemingly two steps back in a lot of U.S.-China relations. On the subject of this new phone, which is, of course, revealed just a week after they initially revealed the Mate 60 Pro, it really is the chips that are of concern to the U.S. here. This includes an advanced made-in-China chip, a 7-nanometer made by SMIC or SMIC, which, of course, is the Chinese chip maker. It also is under restrictions in the U.S., restricted from accessing American technology, just like Huawei is. And Huawei has literally billed this phone as a sign of a triumph against U.S. sanctions. So now the U.S. government has actually launched an investigation into this purported chip to see whether or not the restrictions that have been put in place have failed, or maybe they need to be tightened. You have the likes of Congressman Mike Gallagher, who chairs the China Select Committee in the House of Representatives, who is saying that they may need to end all exports to both Huawei and SMIC. China, for its part, though, countering that, a spokeswoman for the foreign ministry today, saying sanctions will not stop China's development and will only strengthen China's resolve and capability to seek self-reliance and technological innovation. And of course, speaking of interesting timing, John, all of these developments in regard to Huawei's smartphone are coming at the same time that Bloomberg is reporting that the Chinese government is looking to restrict further the use of iPhones for government employees, potentially state-backed agencies and other state-owned entities, as you were referring to. So it speaks to potentially a kind of smartphone war developing in the Chinese market, which is very important, as we know, for Apple.
Just a week away ahead of that new iPhone. Katie, thank you. Alongside AMH down in Washington. Joining us now, I'm pleased to say, Binky Chada, Deutsche Bank, Sarah Hun, Alpine Saxon Woods. Sarah, let's start with Apple. If Apple, with the diplomat Tim Cook at the epicenter of that company, is in the crosshairs of tension between the US and China, who else is the Sarah?
Well, I think that this is a problem for the entire supply chain, right? Because on the one hand, you want to restrict technology because you don't want the things that we're trying to avoid. On the other hand, we're selling into China. It's a big market. So there's a lot of tension here. And the supply chain, you can see that some of the suppliers got hit yesterday, too. And the question of whether or not they can start to develop their own chips also is a big question and a problem at the moment for Western companies. Although eventually, all those things will sort themselves out. But right now, it certainly seems to be in the crosshairs.
Binky, two issues in China right now, two dimensions, regulatory and growth. For multinationals, throw in a third aspect, a stronger dollar. How challenged, Binky, are some of those multinationals listed in America with exposure to those things?
I'd say a little vulnerable. I would say, as you put it, there's the cyclical and there's sort of the longer term and structural. I would argue, on the cyclical side, we sort of remain constructive that, the recovery is happening. It's happening a little bit slower, but it's certainly not sort of, a situation where the bottom's falling out. And there's, from a cyclical point of view, reasons to be constructive. And so I would see a pickup. Now, as far as the structural issues are concerned, I mean, they're clearly negative, but I would say, they take a long time to play out. And in the meantime, in the near term, it's really more about the cyclical. And I think the cyclical, it looks to us like it's going to be okay, is the way I would put it.
Binky, I've got a bit of time with you around the opening bout, you and Sarah. There's a big question for me, and it's actually born out of your research, Binky. I'm going to ask this question. The earnings and macro cycles. Binky, just give me the tease. We can have a longer conversation in a moment, but do you think they are unsynchronized at the moment?
Well, they're not unsynchronized in the following sense, and that is that what we've gotten on earnings is a reality. What we've gotten on GDP or other macro indicators is also a reality. And what those two realities are both saying, especially earnings, is that the bottom in earnings was in the fourth quarter of last year. Yes, we had 2 quarters of negative growth. But this year, what we've seen is basically a very strong recovery. When you look at earnings, the same way that we look at macro data, which is sequential, quarter on quarter, and of course, seasonally adjusted. We had 3.5% sequential growth in the first quarter, very similar in the second quarter, and looks like it's going to move up in the third quarter. So that's basically saying that, the recession or the slowdown, a mild recession slowdown, happened basically last year. And what we are seeing now is basically the recovery. Now, the disconnect or asynchronization has to do really with the consensus forecast, which is still for, a very, very sharp slowing in growth.
We'll discuss that recovery, Binky, in just a moment. Binky Chadha, Sarah Hunt, the President of the United States, 6:55 in New Delhi, India, touching down for the G20 this weekend. Let's get you some morning calls. First up, Deutsche Bank upgrading First Solar, growing increasingly confident about the company's margins. BofA upgrading Gilead to buy, highlighting its underappreciated pipeline. And finally, JP Morgan cutting Apple, the price target to $230, seeing limited upside due to mounting China headwinds. Up next, Dan Ives of Wedbush, why he thinks the latest Apple news is nothing more than loud noise. Three-day losing streak on the S&P 500, down around 1.5% over those 3 days, and looking at a weaker losses on the S&P. Futures right now almost totally unchanged. On the Nasdaq 100, just a little bit softer, difficult there over the previous 2 days, with Apple down more than 6%. There's your opening bell. Switch on the board and get to the bond market. Yields shaping up as follows on a 10-year, down about a basis point. Your yield 4.23. Your euro, a break of 107 in the past 24 hours. Had a little look at 106 again this morning. 107.11 right now. That currency pair positive by 0.1%. And what a run for crude. WTI 87, handle $87 and close to 10 cents. We're up this morning by 0.2%. About 20 seconds into the session, we are dead flat unchanged on the S&P 500. Similar story on the Nasdaq. One stock to watch at the open, it's Apple. Looking to snap a 2-day losing streak that's wiped out nearly $200 billion of the company's market cap. JP Morgan expecting recent developments to continue weighing on shares, writing this: outperformance in the second half is unlikely now, given its premium valuation and mounting risks in China. Ed Ludlow has this one. Morning, Ed.
Yeah, good morning, Jonathan. We are rebounding this Friday. Apple up 0.8%, following a 2-day decline Wednesday, Thursday that saw the company shed around $190 billion from its market cap. Apple has its iPhone 15 launch event next Tuesday. I will be there with Bloomberg Technology, and it's interesting because if you read Mark Gurman's reporting about what to expect, it's the latest proprietary silicon that goes into those iPhones, 3-nanometer A17 processor and U2 RF chip. Those are the things to watch. But in the context of what we learned this week about Huawei, the potential of the Mate 60 Pro, by Huawei to take on Apple in that market. We know that Huawei is 2 generations behind, irrespective of what happens with the US investigation into its chip. You cited the JP Morgan note. I'd note that Citigroup also has a note out with a similar tone, that the news flow and indeed the competition from Huawei's Mate 60 Pro in China could weigh on the stock going forward. It could impact the market there. And I'm sure you've had a range of conversations on the Open this week. We have on Bloomberg Technology that no one really agrees what's going on between the US and China, whether it will impact Apple's growth in that nation, in that market of Greater China going forward. I just remind you what we discussed yesterday, that in the June quarter, Apple swung to top-line growth in China of 8%. And what was the catalyst for that was people switching to the iPhone or buying the iPhone for the first time in China. Maybe we'll get a sense if that continues, if the hardware upgrades that are coming next week in the 15 are substantive enough.
Ed, I've got that note from Citi. Work with me here. I'll read out some of it for our audience. This is what they've got to say. We view the recent news flow around China and Huawei's latest launch as a headline risk for the stock, but the analysts reiterating the buy rating and closing out the upside catalyst watch on the shares, whatever that means, ahead of the launch next week.
Yes.
Within that note, I think this is interesting and it's important regarding Huawei. Citi say this about the Mate 60's technology, still 2 or 3 years behind, and raise an important question that I'm going to talk to Dan Ives about over at Wedbush in a moment. Limited production capacity. Does it really have the mass scale to compete with the likes of Apple and the iPhone 15?
So, exactly so, John. So there were 2 big stories this week in simple terms. The first was the Chinese government telling government employees and state-owned enterprises to move away from the iPhone and use a domestic handset maker. What impact will that have? We don't know. That's where we're undecided. Huawei unexpectedly bringing out the Mate 60 Pro, it sold out and ran out of inventory within hours. And so the analyst that Bloomberg have spoken to says that indicates limited volume, but by extension indicates that even with 7 nanometer nodes, they are still not at volume. 7 nanometer is 2 generations behind the chip that Apple will put in its iPhone 15 to be announced next Tuesday. So there is not just a technology gap, but Apple clearly has a volume technology lead that the domestic players in China have not yet got. And even if Huawei can turn to a domestic name like Semi Manufacturing International or SMIC, they're not at a place where they're building at volume. And so the availability of that handset, per the note you just cited, seems limited.
Ed, stay close. We'll talk about it again in about 10 minutes' time. That stock is rebounding by 0.9%. Rough couple of days for that name. Rough start to September. NVIDIA looking to turn things around with a partnership with Reliance to develop AI infrastructure in India. The CEO slating India has scale, data, talent. Reliance can build its own large language models that power generative AI applications. Abby has more. Hey, Abby.
Hey, John. And yet, well, right now we have NVIDIA trying to flip positive. I would say that this news is a positive, more so for Imbue as opposed to NVIDIA, because when you think about it, they're a part of a $200 million investment in this AI startup. They have a greater than $1 trillion market cap. So it's a very small investment for them, but nonetheless to create AI agents capable of reasoning. And the goal is to make users more productive. But what we really have to take a look at here, John, is the month of September. The last 2 months of September for NVIDIA have been very rough. Last year, down 20%. The year before that, down 7.5%. This year is no exception. Right now, we're down 6 to 7%, the worst month of the year. And this also is the second big decline in just a couple of months. If you recall, they put up that blowout quarter, and instead of doing what happened back in May, where the stock just absolutely rallied to new record highs, it gave back 10% of that. So now we have a double decline, having everything, of course, to do with this year's monster rally, up 220%. Interestingly, because the numbers have been so big recently, valuation, for the first time that I can recall looking at, doesn't look ridiculous. They're actually trading at a small discount on multiple metrics to their peers. Something I would point out, though, John, there's a huge air pocket on the chart between about 300 and 400. Typically, those tend to fill. It would come on some big fundamental reason. It'll be interesting to see if and when that happens, John.
Abby, thanks for that. Let's get an update on the auto sector as well. GM has made a counteroffer to the UAW, proposing a 16% pay raise for top wage earners. And that's been rejected. Here's the quote. GM has come to the table with an insulting proposal that doesn't come close to an equitable agreement for America's auto workers. Katie has the story. Hey, Katie.
Hey, John. Yeah, United Auto Workers President Sean Fain not mincing words when it comes to that GM proposal. He also said to GM, stop wasting our members' time. Now, that GM proposal, it was actually slightly higher than what Ford had offered the union, and it also included $11,000 in inflation protection payments, but still falling well short of the 46% raise that UAW is aiming for. Now, Bank of America was out with a note this morning on the situation, writing that the fact alone that we've seen counteroffers from GM and Ford suggest that some progress is being made, but of course the parties remain far apart in this scenario. And as such, a UAW strike is, quote, almost guaranteed when the master agreement expires next Thursday. The good news, if you can call it that, John, is that the valuations for GM and Ford, they both already reflect the risks of a material strike. That is according to Bank of America. And if you take a look at the shares, both down double digits over the past 3 months.
That's a big story for next week. Katie, thanks for that. I want to turn to the banks and stay on the labour story. Goldman plans to dismiss underperformers as soon as next month in another round of job cuts. This according to reporting from the Financial Times in the last 24 hours. Shanali has more. Hey, Shanali.
Hey, John. This, too, is a story regarding pay, because if the culling happens at the end of the year, as it does at the major investment banks on Wall Street, it makes room to pay the top earners more at the end of the day. And again, the pool has been weak this year with a tough year for investment banking. Now, the Financial Times is also reporting that they are looking to cut at the low end of the typical range of 1% to 5%. That amounts to about 440 jobs. The concerning thing about this year is for the folks who are losing their jobs, there have already been thousands of job cuts, as well as many tens of thousands more when you think about that consolidation over at UBS and Credit Suisse. So a lot of concerns about the excess capacity in this job market and who takes it up. But again, these bankers are also trying to squeeze through a better year next year.
Shanali, thank you. We'll talk more about that next week. Just the labour market, differences there. Some weakness on Wall Street, then the tightness, the labour market pad we've been talking about with the autos and the big three in Detroit. Back with us, I'm pleased to say, Binky Chowdhury, Sarah Hunt. Sarah, thank you for your patience. I really wanted to get to this story with you. The labour market tension for the big three in Detroit. I mentioned this to Mohammed, whether this is the dying embers of a hot labour market or a story that's going to crush margins into next year. Which one is it?
I think it's a combination of the two. I mean, first of all, you've got the issue of deglobalization and the issue of relevance, right? Because you're looking at changing over to possible more EV vehicles. So part of this move on the labor unions, I think, for the United Auto Workers is staying relevant and making sure that whatever changes occur in the economy, they still have a place. I think that there is more, labor does have some more power now than it used to, just because the manufacturing is so much smaller now that the ones who are doing the manufacturing, if they do pull back, that is going to be an issue for those three companies. So they have an incentive, just like the pilots had an incentive and the airlines had an incentive. I think that you're starting to see companies who have been able to charge more for the consumer, their workers are looking back and saying, hey, you guys are making record profits. We would really like a piece of this.
Binky, strong labour market, 1, commodity prices higher, 2. Where does the earnings acceleration come from with that in mind?
So I would say, the earnings acceleration should basically come from top line growth. And at one level, all I'm saying is that what's been going on for the last 3 to 4 quarters, which is, above trend GDP growth, it's not obvious to me that I see a reason, barring some big shock as to why that's suddenly going to change and we're going to fall off a cliff, basically. I would just sort of, this point that I was making earlier, I think is worth keeping in mind, which is basically, at the end of last year, first day of this year, if you looked at the consensus of economists forecast, what you would see is basically a V-shaped curve, strong growth, coming off very, very sharply. And sure, it was going into a negative territory. And so the headline of recession, what we've seen is 2 months later, the V moves, perfectly horizontally to the right. Another 2 months later, we move for the third time. And then finally, we move to the right and we move a little bit up, which generates the headline that the bottom is no longer a recession. But I think the more important point really is that the shape that the consensus has for growth remains exactly the same, which is for a very sharp and very severe slowing that has continued basically to get pushed out. And I think that that's, really the main driver, this big driver of the rally so far. And given where the consensus is, I think the potential for this to go on for some more time, remains basically high. As far as the tightness in the labor markets is concerned, my answer to your question would have been neither. I think the labor markets have been tight for 2 years or so. It's not just really in the U.S. And I think, what we have not really seen at the macro level is the corporate response basically to that tight labor market. There hasn't been enough time. And of course, we have the shadow of what we were just talking about, which is, growth is going to fall off a cliff and we're going to go into a recession. And so that's going to sort of slow the response. But if you look back historically at periods of tight labor markets, they've been very important driver by themselves of productivity growth. And so if we don't get this sharp slowing in growth and if we don't get this recession, I think there's a strong possibility that we get much stronger productivity growth. And that, of course, is, very, very positive for the medium-term outlook.
Sarah, that sounds very constructive. Are you on the same page as Binky here or taking the other side of it?
I'm not sure I'd go fully on the other side, and I think it's kind of funny that we have a both and a neither response. But I think that I have more concerns about whether or not you really are going to see an uptick in earnings the way the consensus is pricing in for next year. I'm also concerned that a lot of the slowdown that we've seen, or we haven't seen so far, that we've been waiting for, is starting to chip around the edges. I mean, if you listen to Thorsten Flock this morning, he was talking similarly about the fact that there is underneath the surface, you're starting to see some real tension in lower credit consumers and lower credit companies, and some of that interest coverage with higher interest rates is starting to bite. I think that it's hard to say that there is smooth sailing ahead, and I think that the idea that we're not going to get some sort of a slowdown, even if it's not dramatic, is still where the market is priced, equity markets at least, and where consensus is pricing earnings, does look like we're still hoping for some really good news to come through. And I think that I'm a little wary that it's going to be as strong as the expectation is there.
Sarah Hunt, Binky Chowdhury, to the two of you. Thank you. About 13 minutes into this session, this equity market positive by 0.2% on the S&P 500. On the Nasdaq, up by 0.4%. Coming up, Apple rebounding after shedding nearly $200 billion in market cap in 2 days.
Their supply chain is heavily dependent on China, where they leverage Foxconn, and Foxconn employs more than 1 million Chinese to assemble their products. But they're clearly caught in the middle here between escalating tensions.
Dan Ives, Wedbush, up next.
China has to, be very careful to what they do with Apple, because China depends on Apple for many things. They are even more important in the upstream of Apple than the downstream of Apple. The direct impact of these bans is very, very, and to be honest, actually invisible.
News Street's Pierre Ferro expecting Apple to overcome the latest China developments. This after shedding nearly $200 billion in just 2 days as Beijing seeks to broaden its iPhone ban even further to state firms and agencies. All this just days before the iPhone 15 launch event set to take place next week and named Wanderlust, whatever that means. Dan Ives of Wedbush maintains his outperform rating and 230 price target, saying this: in a worst-case scenario, any China government agency iPhone ban is way overblown, citing the ban would affect less than 500,000 iPhones out of roughly 45 million expected to sell in China over the next year. Dan Ives, I'm pleased to say, joins us right now. Dan, wonderful to catch up with you. Tim Cook, as you know, the diplomat, he has really navigated these issues with the US and China so well over the years, and finally he finds himself at the crosshairs. Now, I wonder, Dan, from your perspective, what that means. If it happens to Tim Cook, surely it can happen to anybody.
Yeah, I mean, but in my opinion, this is barks will out worse than bite. I mean, in terms of all the work we've done, we're talking 500,000 iPhone units and probably less in terms of any sort of ban that we've seen with some of these government agencies, which has really been there for the last few years. And look, I get it. Many people are going to yell fire in a crowded theater, like they've continued to do year over year. We'd be strong buyers here. I think we're going to look back on this as more the opportunity rather than a time to really say structural problems are now ahead for Cupertino.
Context perspective matters, Dan. I understand the numbers like you do. It makes perfect sense. But I think what we're missing here is the signal, the optics. Are we missing a change in mood away from foreign luxury, US hardware, US tech, Apple specifically? Are you missing that shift in mood in China?
Look, at the end of the day, Huawei right now, 2 generations behind. It's essentially the JV phone, right? I mean, no Chinese consumer is going to go out and go for this phone over an iPhone 15, which just continues to be gold standard. Now, look, in terms of the cold tech war between US and China, no doubt that Apple as well as Tesla continues to be caught in the middle. But the tactician Cook continues to navigate this. And also remember, when you look at Foxconn's supply chain, you're essentially talking about the #1 employer in all of China in terms of Apple. So I get the nervousness, but I just continue to believe it's going to continue to be 20% of iPhone. And I think growth is actually going to happen and actually market share in China rather than the opposite.
Dan, we are talking about a communist country, though. Why would what China believes is good for its government is any different to what China believes is good for its people?
Because they're basically the biggest employer in China. And if you look within Beijing, especially spend a lot of time in and around China and Asia, it's a trophy case that Apple, that's where their production is. And ultimately, if you look at Cook, despite Vietnam and India and some others, they've continued to really bet the farm in terms of China. That hasn't changed. So this is all a game of poker, and I get some shots across the valley in terms of where Huawei is.
Yeah.
But I just don't see them shooting themselves in the foot. That's our opinion. Continues to be, despite haters continuing to hate on Apple yet again.
And you're perfectly entitled to your opinion, sir. Going into next week ahead of the iPhone 15 launch, Dan, here's the question for you. You always talk about that upgrade cycle, the elusive upgrade cycle. You and I have been talking about that for years now. At what point does that bullish thesis become a bearish one? At what point do you just ask, Dan, why aren't they upgrading?
Yeah, well, I mean, look, if you look at the last year and a half, a lot of those upgrades have happened, but it's almost a high-class problem because they've gained an incremental 125 million users over the last 2 years. 250 million iPhones have not been upgraded in 4+ years. And if you look at this special chip camera technology and what continues to come out of Cupertino is the gold standard. And that's why I believe, especially with a lot of big carrier discounts, this is a mini super cycle, despite a lot of the bears coming out of hibernation mode, after Apple's run.
It's amazing you're talking about super cycles at a time when we've basically got no growth for the core product. Dan, why are we paying up to 30 times earnings for no growth?
Okay, so I continue. First of all, when you factor in FX, it is growing. And then I think it's all about into the next year, where you're going to have mid-single-digit unit growth. You have ASP growth, which is actually double digits, and it's services. I think how many have missed Apple going from hating it at $1 trillion, despising it at $2 trillion, now pulling their hair out at $3 trillion. It's a services business. The sum of the parts we believe is worth 1.4 to 1.5 trillion. And I believe we sit here in the next year and a half, and this is on its way to 4 trillion. This is not the end. It's just the middle of the next cycle.
We won't wait a year to catch up. Dan, it's good to see you, as always, going into next week. Dan Ives of Wedbush, still bullish on this name, as you might expect. Apple bouncing back here by 1.4%. Let's get you some sector price action. Here's Abby.
And it's because of Apple's bounce back that tech is the top sector on the day, John, up about 0.9%. But as you would say, not a lot of drama here. Not surprisingly, with a small gain, we have a few sectors higher. There's actually more sectors lower for the S&P 500, led by the industrials and financials, but down about 0.3%. On the week, though, it's a different story. 10 of the 11 S&P 500 sectors are lower. Energy is the exception, up 1.1%, with oil being higher. But again, a down week for the S&P 500, John.
Abby, thank you. Coming up next, your trading diary going into the weekend and a sneak peek of next week. 25 minutes into the session, attempting to snap a 3-day losing streak on the S&P 500. Positive here by 0.2%. Apple, 2-day decline of more than 6%. This morning, at least, a little bit of a lift, a bounce back. Let's see if that sticks. That's the price action. Here's your trading diary going into the weekend. The G20 summit kicking off tomorrow. Sneak peek of next week, Tuesday, Apple unveiling its latest iPhone. Wednesday, US CPI. On Thursday, it's the UAW strike deadline, plus another round of jobless claims and an ECB rate decision. From New York, that does it for me. Thank you for choosing Bloomberg TV. Good luck for the rest of the trading day and have a wonderful weekend. This was the Countdown to the Open. This is Bloomberg.